Valuable to them, and they've never had, because they're from the masters side, they've never had this kind of just lending classes, and so it's been a huge success for a lot of our agents. So thank you
Excellent.
for providing this great information. You do a phenomenal job, man. So awesome stuff.
Appreciate it.
All right, floor is yours.
Sounds good. Let me share. Where am I headed here? Bam. You guys see my screen?
Yes.
Awesome. So once again, for those, and here in recent weeks, I realized that there are people that chime into the calls that are not necessarily in our email chain. So for those of you that don't get the handouts or anything that I go through, I'm happy to send it to anybody. You just got to get me your information. I've had some people in the chat box they put in there, please send it to me, and then I'm getting your contact info, and there's just a first name in there. So yeah, if you want it, I'm happy to send it to anybody. And you can call me anytime, whether we're working transactions or not working transactions, happy to help anybody, with anything, or kind of help along, and any little nuggets of information I can. Success breeds success, no doubt about that. So a lot of the training over time that I try to focus in on also comes down to recurring questions and things that pop up. There are so many people that are out there, very difficult for us in the industry to cover every single situation that might occur. So as much as even from a coaching standpoint or training standpoint, we're trying to hit the high points, and get everybody conversational and understanding what's going on, but really difficult. So I've had a handful of people here in the last couple of weeks that have seen flyers and advertisements from other competitors of ours, other lenders that offer 3% down, no mortgage insurance. And some of our agents have been like, man, that is great. Can we do that? I've even had some of our newer loan officers, newly licensed, I should say, loan officers ask the same thing. I had somebody ask me about this, how does that work, or what does that mean? Or, and I think just as far as the industry goes, and it just insurance itself has been around for the better part of probably about 125, 130 years or so, whether it's home insurance, life insurance, whatever the case is. I'm not an insurance agent. My 2-bit opinion, a little bit of a racket. It's basically a catastrophe insurance. Any insurance that's out there, it's maybe not, kind of a day-to-day, but if quote unquote shit hits a fan, and I want something that I can fall back on, so it doesn't wreck me financially. So I get the premise. There's nothing, if you want to call it a quote unquote racket, nothing's more of a racket than this almighty title insurance that's out there. But the title insurance companies that are charging for these prelims, Alta policies, whatever the case may be, that are making money hand over fist, have just based on their checks and balances, very, very little instances that they'd have to pay out. But from a lender standpoint, they want to make sure that their lien position is secured and the whole bit. So we're talking today about this almighty mortgage insurance, or MI. There are companies out there that offer it. PMI is an entity that offers private mortgage insurance. MGIC is another one. UGI. There are a handful of nationwide players. But what the hell is mortgage insurance? And really, at the end of the day, lenders offer programs with very little to no down payment. And with some programs that are out there, they offset requirement for mortgage insurance to cover any high-end losses that they might incur. So right off the top here, this definition here, what the hell is mortgage insurance? It's an insurance policy that protects the lender. It does not protect the borrower. It's not something that's in place as much as it sounds like, well, if anything happens, or if I get hurt on the job, or God forbid, there's a death of a wage earner within the house, then we have this mortgage insurance out there that's going to kick in and it's going to pay the mortgage for us. Not the case. There is mortgage life insurance is a completely separate entity that's out there that might cover the borrower, but the standard MI protects the lender, does not protect the borrower. So if the borrower defaults on the loan, they default on payments, they pass away, they're just unable to meet the obligation of the loan, the mortgage insurance kicks in and it covers the lender on any high-end losses. And that's really the spot in play there. The next line item below here says mortgage insurance is in place until the loan balance is reduced to 78% of the original value. And at that time, the lenders have the choice of deleting it or not, but there is nothing in place that says that they have to delete it or that it automatically just falls off. And you went from paying it month in, month out. You finally got to that point in time that it should be deleted, that it's just magically gone. For most lenders that are out there, they'd rather have the mortgage insurance in play than not because they're protected. If you hearken back to the downturn in the economy from 2008 to maybe 2011, 2012, the mortgage insurance that was in place, it is insuring the lender down to 78 cents on the dollar for losses. So if the next line item right below here has an example of purchase prices, and it's just simple math in your head. But if they're doing a purchase price for $100,000 at 5% down, it's a $95,000 first. It is picking up that insurance for any losses all the way down to $78,000 in that example. From 08 to 2011, the losses were so great that the MI was, might have clotted some bleeding, but the fact of the matter is lenders lost to the tune of trillions of dollars because the property values decreased by 60 to 70% at the time. So the lender is not otherwise motivated to want to automatically delete it. This whole term usually here, and even just, I ended up going online and doing a little bit of research, just to double check, make sure I'm not missing anything with regards to any products or programs that are out there. And I saw that term usually more than a time or two. Even for government conventional programs, like, that seems a little odd. So it's basically what I would say is to the lender's discretion. If they choose that, hey, we're in a pretty sweet spot, then it would come down to lender per lender in comparison to something where it's just an automatic across the board. I bring up 08 to 2011 or 12 because the fact of the matter is it's only about 10 years or so ago, and the losses that lenders incurred at that spot in time were so great that, case in point, if they had a client that maybe purchased a home in 2002, and then they got to the 78% loan to value mark by maybe 06 or 07, the lender opted to delete the mortgage insurance or MI, and then shit hit the fan in 08, and the property value just absolutely tanked and fell through the bottom of the floor. The lender is kicking themselves because they had the protection in place. They opted to delete it, and then they got sucker punched with the decrease in values that nobody saw coming. So it's kind of, it's frustrating, but the almighty MI, it is in place until you get down to that 78% of the original value. Also, it isn't anything that says the lender is constantly updating value, reappraising, doing some statistical valuation or background checks, or it's not something that's on the top of their mind to say, hey, let's make sure that we're protecting the consumers and we're deleting this thing the very first second that we can. So on programs that are out there, and this mortgage insurance is applicable in the following programs. How does this whole thing work? FHA is really cut and dry. So the FHA loan program, really geared towards first-time home buyers. HUD created the FHA program in 1934. Been around forever. It's a great product for first-time home buyers. I certainly am not going to downplay it. From the standpoint of the mortgage insurance on FHA loans, doesn't matter what the loan to value is. It's on every loan they do for FHA. So you could have a purchase price for $100,000, $50,000 loan amount, 50% loan to value, and you're still looking at paying monthly MI. You'd come back and say, that doesn't seem right. Why would anybody ever do that? That makes no sense. FHA has pretty lenient guidelines. So FHA is going to allow for things like a bankruptcy that's only 2 years old, with exceptions to just 1 year. They're going to allow for a foreclosure that's only 3 years old, with exceptions for lesser seasoning. Conventional loans don't have those low ball seasoning requirements for bankruptcies and foreclosures. The income in relation to debt, your debt can be a lot higher, the quote unquote debt ratio, a lot higher with FHA than with conventional. You know, so FHA's got, it has its place in this world. I'm not going to downplay it, or discount it. But it would be required in every single loan to value that's out there. Yeah, Matt was just walking through the room here. One of our loan officers here that mentioned he just recently did a purchase for 50% loan to value, had to go FHA. So it's the difference of, we talk about the profile that he had was a 560 credit score. We can get FHA, by the way, all the way to a 500 credit score with a 90% loan to value. So with just 10% equity in the property, we can get an FHA loan at 500. Conventional loans are 580. So now you come down to, hey, the person's got some down payment. I'm a 507 mid credit score. Can you help me? We can. So I'm going to talk about everything that we can do for every single borrower out there, rather than dangle the carrot and talk about things that we can't do. You know, on that 507 with 20% down payment, 507 credit score, 20% down payment, that would be an FHA product. You know, and I can sit here and say, what if your credit score was higher than 580, then look at all the other things we could do for you. You know, I'm really setting them up for disappointment, because 507 to get all the way up to 580 is a bit of a stretch. I'm not saying that we can't work on trying to get their scores up, you know, through the Wayfinder and What If Simulator, 2 software programs through our credit agency, but tough place. So FHA has its place. But once again, MI is required on every loan to value out there. Doesn't matter what it is. And it's really cut and dry. So the factor that they have, the MI premium factor, it's 0.85% of the loan amount. So on a calculator, 0.0085 times the loan amount divided by 12 gets the monthly MI. So the factor is 0.85. If the loan to value is 95% or less, then their MI factor is 0.8%. Okay, is what it is. So they got 2 premium factors there. That's it. And there's no getting around it. So FHA, it's not like, well, you know, they're an 837 credit score. You know, could there be an exception? No. They have the nicest smile. These people are so wonderful. It doesn't matter. You know, they have $1 million in the bank. Nobody cares. You know, the fact of the matter is, if you're booking an FHA loan, there's no getting around it. You know, so for that loan to be funded, it's got to be booked with monthly MI. You'd come back then at a 50 loan to value and say, well, wait a second here, because, you know, up above, you know, Greg's telling me that it can be deleted at 78 cents on the dollar. They got to have the monthly MI to book the loan and insure it as an FHA loan. Okay. And so it's got to be set up. Is the lender motivated a month or two after funding at a 50% loan to value to say, you know what, we'll delete it now? Probably not so much. It's going to be case by case. And it isn't anything that I'd go back to and say, oh yeah, no problem. You know, 4 months from now, 8 months from now, you know, all you need to do is just hop on the phone, make a quick call, and that thing's gone. So it's really going to come down to the lender discretion on something like that. And like I say, they're not quick to delete it. It's nothing where they're jumping through hoops. And they're not profiting by it. So it's not something where they're making money on the MI, but they have the safety net. So they have that security that it's in place and it's there. So the other government type of loan that we do a lot of, this almighty VA loan, they don't have any monthly MI on any loan to value. VA will do 100% financing, no MI. Okay? Home run of a program. So from the standpoint of the risk, you come back and say, well, you know, aren't they concerned? What if they default? I've been doing this for 33 years now, and there is no product or program out there that has a better repayment history than the VA loan program. Say whatever you want to say about it. The people have served, actively serving or honorably discharged from the military pay their bills at a greater rate than people that have not served and or currently serving the military. It is what it is. You can sit here and say maybe they have a little bit more respect for the fact that you lent me the money and I'm going to pay you back. You know what? Unless something, or do VA loans ever default? Hell yeah. There's no perfect world, but they're going to go like to leaps and bounds. I think for a standard person on a VA loan, if they had to take a second job or a third job in order to meet their obligations and pay their bills, they probably would. The conventional loan, can't we modify the loan, or can't we renegotiate something? Or I'd really rather not work weekends or nights, or so I mean, you can dress it up any which way that you want, but the VA loan program and product, FHA and VA rates are great. So they definitely beat the conventional rates that are out there. And you can sit here and say, well, FHA's got the safety net with monthly MI. VA has no safety net, but the reality of things is the loans they pay out. So, from the standpoint, and I've been doing it forever and a day, there's never been monthly mortgage insurance on any VA loan ever. So it's not even an exception, whatever the case may be. So win-win there. On conventional loans, it gets a little bit more dicey, and we have looked at pricing because we went through last week and kind of hit the almighty question and touched on pricing adjustment. But most people, what's the rate? What's the current rate? What are rates? How are rates looking? What's today's rate? And it's not even a fair question. Even for somebody, I've been doing this forever, as I mentioned. Somebody off the street can come up to me, or it could be somebody that's my nearest and dearest best friend. It could be a sibling of mine. It could be the best man in my wedding that I've known all of my life. And I'm still going to have to quantify what is the rate question with what are you looking to accomplish with what's the property value, what's the loan amount, is going to drive the loan to value, is it a primary residence, second home, or rental, is it going to be a purchase, a no cash out refi, a cash out refi, what's the property type, is it a single family, manufactured, condo, multi-unit? So people that are familiar with the industry, if you're not asking pre-qualifying questions, then anything that I blurt out, I'm an idiot, because I have no idea who I'm talking to. I don't know if the person is an 800 plus credit score with 50% loan to value and a primary residence, or they're a 600 credit score wanting to buy a 4-unit, non-owner occupied. They don't get the same rate. Okay. So conventional loans, when we looked at that pricing last week, there's a huge spread over who gets what rate and why. And it kind of holds true with the MI as well. So the term I used last week when we talked about this in training, Fannie Mae and Freddie Mac are conventional loans. They have something called risk-based pricing. Better the risk, better the rate. FHA and VA is not nearly as tight when it comes down to that. They're really broad-based. Conventional is very tight. So the monthly mortgage insurance falls into that as well. It's required for anything greater than 80% loan to value. So if you bought a property for $100,000 and your loan amount was $80,000 on the nose, that's 80% loan to value, no need for MI. Your loan amount is $80,001 or anything higher than that, then mortgage insurance kicks in. Okay. So if we're just missing the 80.000%, we're going to try to make every effort to get to 80 on the nose and not have to worry about monthly mortgage insurance. So the next little comment in here that I wrote on the sheet is the MI factor is risk-based. Okay, what the hell does that mean? That means the premium factor doesn't go cut and dry like FHA up here, 0.85 and 0.8. What the conventional says, the MI factor and the premium factor is higher, which means you pay more mortgage insurance if you're at a higher loan to value and a lower score. So somebody at 95% loan to value and a 620 credit score, as long as we can get the approval, you can do that as a conventional loan all day long. Your note rate for the loan is going to be higher for a 620, 95 LTV than somebody that's an 800 with a 70% loan to value. You have 30% down on an 800 score, you're getting a better rate than somebody with 5% down on a 620. You're more risky with less down on a lower score. The mortgage insurance or MI is higher. The premium factors are higher with lower scores and higher LTVs. And then I wrote in here, and conversely, the MI is lower, which means they pay less if it's a lower loan to value and higher credit scores. Okay. So it's all kind of relative. I've had instances with people very recently where loan officers are pricing transactions. We have a 637 credit score with 5% down payment. We're going into a conventional loan. I'm looking at it with them. Let's look at the FHA side by side. Let's see where they're getting better financing terms. Well, but they got 5% down. They could get conventional. You know, they really wanted a conventional loan. If they meet the FHA loan limit, you know, I mean, they could come back and say, I don't even know why you bothered to put up that option. We want the conventional loan. You can get the conventional loan you want. But in certain instances, FHA might come in at a lower rate with lesser MI and a better payment at the end of the day. And if they opt to go into the conventional option with a higher rate and a higher payment, and you know, it goes against any common sense thread or notion that's out there, how about it? I mean, who am I to tell anybody? All I'm doing is creating options. Okay. So it's not a given that on any particular program, based on what people are putting for down payment or credit scores, that the program's always going to be this and not that. Okay. We're going to take a step back and look, where are they getting better financing terms? So this next little note in here that starts in with MI can be bought out. The hell is that? You can, at any particular loan to value, buy out the monthly MI. What the heck does that mean? In essence, really, the lender is going to say that rather than you pay a monthly figure, I'm going to create a pricing adjustment. And let's say your monthly MI is $300 a month. I'm going to create a pricing adjustment based on your loan amount that's going to be in line with an adjustment to your rate and then payment that's going to be hand in hand with what the monthly mortgage insurance payment and premium would otherwise be. Why would anybody take a higher rate? Why would you ever do that? Okay. And I ended up writing down below here, MI can be bought out with an adjustment rates and fees for the loan with lender paid MI or LPMI. So how does any competitor of ours go out and say conventional loans with 3% down payment and no MI? You know, and the general public is like, man, that is awesome. Anybody out there can do that. Okay, so much like any other marketing piece, it's very, very, very rare that people are out there advertising something that no one else can do. It's just a spin to make it look easy on the eye and appealing. You know, so could we do a conventional loan without MI? Yeah. They qualify for a conventional line. You can pay it or not pay it. Pick a winner. Okay. The note here at the bottom, or the end of this number 3 that says MI can be bought out with the LPMI. The mortgage insurance is not tax deductible, whereas an increase to the rate and the subsequent additional mortgage insurance paid is tax deductible. So the IRS allows you to reduce your taxable income by deducting mortgage interest, but does not allow you to reduce your taxable income with mortgage insurance. So the mortgage insurance, unfortunately, is money you're throwing into the wind. Okay, it's benefiting the lender for any high-end losses, and at the end of the day, you know, it does the borrower get a little lower note rate? They do. I probably should have typed this in here. It might even be a little bit beyond the scope, but just to close the loop here, if they opt to take the LPMI at the higher rate, do they ever get to drop down to the lower base rate once they hit a loan amount that's 78% of the original value? So up here, I wrote in here, mortgage insurance is in place until the loan balance is reduced to 78% of the original value. If they take the LPMI and we get to the 78% figure, is there a pricing adjustment or how does that work? Unfortunately, there's not. So if you opt to take the LPMI, you have that higher rate for as long as you have that loan. So you get the benefit of no MI, okay? but you don't get the benefit of somewhere down the road to possibly have that pricing adjustment deleted and come down. I looked at a transaction with one of our loan officers, and happens to be a family-owned property where the parents have passed on. The kids inherited the property. They want to refinance. They have a reverse mortgage against the property now. They want to refinance, put it in the kids' names. No problem. All day long. They have all the equity. Everything's great. They can qualify. No problem. No brainer. And it's like a 50 loan to value. I have another transaction that people are refinancing, and the parent is going to gift equity to the kid. And I'm looking at the parent's note. The parents are sitting at like a 50% loan to value on that transaction too. They're still paying the monthly MI from the FHA loan they took out like 12, 13 years ago. Is what it is. It's like $356 a month. If I said it was $400 a month times 12 months, that's $4,800 a year. It's about $5,000 a year that you've been paying for a really long time. You don't need to. It sucks. And what does 5,000 get for you in this day and age? Pretty nice vacation, the entire new like living room set. Like you can stretch it out. $5,000 is going to get you some pleasantries. You can request the borrower can contact their servicing company and request the MI be deleted, and the lender's discretion can say, well, you know what? They may say, you know what? We'll have you pay for an appraisal, and based on the appraisal review, we may delete it. They may come back and say, you know what? We're not going to delete it at this time. And then the only way you'd be able to delete it if they were going to strong arm you is you would have to refinance into another loan. And that's it. So could you refinance the loan? You could refinance the loan and delete the monthly MI. So if you took the LPMI option, you are into the higher rate. And a lot of it comes down to, from new loan officers here, I've trained thousands of people over the years. And what I can say is I'm big on the option close. So with everybody out there, I'll always come back, which option makes more sense for you and your family? And would you rather like this or would you like that? And I've never been one that has ever been a fan of putting together, here is one scenario for you. Do you like this or do you not like this? I prefer not to give you an option to, I don't like this. Instead, here are multiple options. Which one makes most sense for you and your family? And at the end of the day, pick a winner. But it's not going to be, there's no option to, I don't like any of them. Then let's figure out something that you do like. If you felt that I want a lower rate, then let's get options at a lower rate. And here's the cost to buy that rate down. If you wanted less in fees, then we're going to go to a higher rate and we're going to try to, price out the fees. If you wanted a lower payment, and I'm already at the sweet spot and rate, maybe I got to reduce the purchase price, because you don't want to afford, this particular, whatever it is, it is. Well, I mean, some people put themselves, they put themselves in their own situation. So, if I've said it once, I've said it 1,000 times. I don't create people's, situation or scenario for themselves. They create it for them, and I just try to help them work it through it. So, I wouldn't be the guy that says pay your bills or don't pay your bills, have a good credit score or don't, live within your means or don't. I'm not over their shoulder. The second they're out there looking to buy that brand new, SUV, sports car, whatever, like, do you really think you should be paying the $838 a month for that Tesla payment when you haven't even purchased your home yet? I mean, don't you think maybe the home is a little bit more important? Let's get into this for, there are people that make these decisions that are out there. I don't tell you to get a job that pays you a lot of money. I don't tell you to work hard. Some people out there flat out are more, gung-ho and energetic than others. Some people, want more for themselves and their family than others. Some people are just going through the motions. Doesn't even matter to me. The person going through the motions is as much as a an AAA rated A++ type client as somebody that's super gung-ho. I'm going to treat them both the exact same. Okay. So from that standpoint, whatever they crave for themselves, I'm just trying to help them work through it. But the LPMI is definitely there. And then how does that work is the adjustments to the pricing is going to be directly correlated to credit score and loan to value and property type. So if you're coming in and, and you wanted a higher LTV with a multi-unit, so it's all kind of relative one to another. This number 4 loan program in here, non-QM. The mortgage industry, after the downturn in the economy in 08, there was legislation out there, senators by the last names of Dodd and Frank came up with tons of federal regs. So anybody that's taken the MLO test, it's all over the place. So the Dodd-Frank Act imposed more federal regulations in the mortgage industry in the better part of like 18 months to 24 months than we had in the previous 80 years combined. No BS. It was over the top. And really what it came down to is the government in Congress felt that they let down the American public by not regulating the mortgage industry more so and let the states create their own regulatory compliance. And when shit hit the fan, the government felt like, hey, we probably should have done a little bit more. You should have a little bit more of a heavy hand into what's going on. So what is QM right here? It stands for qualified mortgage. So qualified mortgage is somebody that qualifies based on their IRS tax returns. Okay, they qualify based on their verifiable income. Non-QM would be an example here. People can qualify with bank statements for income. And average deposits on bank statements, would be qualifying. That's just one example. There are programs out there that for non-QM, that could be a rental property that only qualifies based on the rental income or lack thereof for that property per month. It doesn't even care. You could be losing hundreds of thousands on your IRS tax returns, only cares about the rent on the subject property. So non-QM would be the non-traditional type loan programs out there. Mortgage insurance is never required. In fact, the MI companies wouldn't touch those products or programs with the 10-foot pole. So they're looking for the very well-qualified, quote unquote, QM, qualified mortgages, which would be conventional loans through Fannie Mae, Freddie Mac. VA is never required. FHA, as well. But so just an example of non-QM. So non-QM bank statements for income. We have bank statements for income that can go as high as 90% financing. You're like, man, that's really good. Boy, why is that rate so high? The risk associated with 10% down and you're not proving your income with IRS tax returns means you're not going to be getting the same screaming deal that somebody that gave me a better security interest with maybe 30 or 40% down with the same bank statements for income. Okay, so it's all relative. Credit score is going to matter on that as well. So those are some examples there. I want to touch on this MI here. And aside from the buy-out of MI through the pricing adjustment with LPMI, how the hell else can somebody else get away from monthly mortgage insurance? You can proceed without MI or any pricing adjustment if you structure your first mortgage up to 80% of the value of the property and offer a smaller second mortgage to make up the difference in whatever you need. And it doesn't have to be even numbers. So I gave a couple examples here, and these are just industry terms. A couple examples. The first one in here is an 80-10-10. Okay, what the hell is 80-10-10? That makes it, what? 80% loan to value on the first. You got 10% of the value in the second and 10% down payment or equity. Could be a refi, could be a purchase. I put in simple math here. The purchase price is 100 grand. Gets you a first mortgage for 80, a second mortgage for 10. You need 10% down in that example. You could do an 80-15-5. That means your purchase price for 100 grand is an $80,000 first, $15,000 second. I can do anything I want. I can do an 80-18. It's not as commonly referenced in our industry, but if they only needed another 2% and they had 18% down payment, win-win. No problem. So on any of these, what happens is your first mortgage is 80% loan to value, such that no mortgage insurance kicks in. You're going to get the better rate for the bigger loan, and you're going to back it up with the smaller loan amount at a little higher rate. Okay? No MI. So there are options that we look at with people on those as well. Does that make sense? Is that better for you? Okay. And it really kicks in if you need a smaller second is where a lot of those kind of fall into play. and say, hey, yeah, maybe that makes sense. Maybe that's a better way to go. We do these concurrent seconds, and I'd be hard pressed if I didn't include this in here, but these concurrent second mortgages. So this is a first and a second, 80-10-10, 80-15-5 means the first and the second are both being processed at the exact same time, and they're both funding at the exact same time. Okay. And it's all for purchase money, or they're done concurrently for a refinance at the same time. So you would do it to stay away from MI. And there are other instances we may do it to stay away, or excuse me, stay within certain loan limits. Okay. So we've talked in previous training sessions, the concurrent second mortgage could benefit borrowers that just missed the maximum conforming loan amount of 726,200. So let's say I'm doing a property in Riverside, San Bernardino County. I have 20% down payment. That's great. Wonderful. And I'm looking at a property. I'll do simple math in our head, so it's easy to calculate, for $1 million purchase price. And I could go into Riverside, San Bernardino County. I could do an 80% loan to value for an $800,000 loan amount. It'd be priced as a jumbo loan program. I'm going to be getting higher rates than the conforming or conventional programs otherwise would offer. It might be that sits better at just doing one loan for $800,000 at a higher rate. It might be that it sits better to bust the first mortgage down to 726,200. The difference here of 726,200 and 800 grand is $73,800. Maybe I do a $73,800 second to keep my first at 80 LTV to the max limit for the most competitive interest rate on the first. And then I back it up with the small second. And maybe that beats the standard first mortgage jumbo all in one loan. Jumbo rates on average sit maybe 0.3% higher in rate than standard conforming do. 0.375%, about higher in rate on average. Some of them could even be a 0.5 point higher. Well, if the difference of me borrowing that much money, 726,000 versus 800,000, and the difference in that spread and rate, it might be that, hey, you're borrowing a lot of money. Let's get it at the most competitive rate we can for the big dog loan. And then we're going to use the smaller second. If the borrower wants to make principal reductions on the loan, you'd pay the one that had the higher rate first. You wanted to send an extra $300, $400, $500 a month, and throw it into that second at the higher rate than the first. And then as soon as you get the second satisfied, then let's go, you want to spend a little extra money on the first, have at it. Okay. But in certain instances, I put in here the conforming loan limit, 726,200. The max FHA loan limit for Riverside, San Bernardino County is only 644. Okay. So if I had a, FHA loan and we were just missing that price point, let's say I'm doing an FHA loan with 5% down. It's a $700,000 purchase. 5% on 700 grand, $35,000 down payment. 700 less 35,000 would be 665. Maybe it makes better sense rather than I got to get a jumbo at that high LTV. Man, just get crushed. Maybe we drop down and we do the FHA for 644 and we back it up with a $21,000 small second. It gets them into the FHA loan limit. It gets them into the most competitive pricing for the biggest loan. We do a very small second. Maybe the concurrent seconds could be to keep within a loan limit. Maybe the concurrent seconds could be to stay away from monthly mortgage insurance. It's all kind of relative. Okay. But certainly there's merit. The seconds that are out there, they're becoming much more prevalent. From everything I'm reading, credit card debt is a result of inflation and just the cost of living adjustments that are out there right now. Our credit card debt in the United States of America is brimming again. So, people are definitely, maxing out. It caught me way off guard that the Black Friday and the Cyber Monday after Thanksgiving this last year, not only did they beat all-time record highs, but crushed them. Billions and billions of dollars spent on Black Friday. I'm reading the math, like, does anybody realize the cost of everything through inflation, how expensive, like what? But the American consumer, for the most part, looks at how it was a deal. It was 30% off. Like, how can I pass on that? So from the standpoint of racking up additional credit card debt, we're doing a lot of debt consolidation loans out there as well, where people might even have a great rate on the first. We could be doing a second. I'm looking at the current first plus the new second, and then comparing it to the new first cash out refi and trying to see, where are they getting the better payment? Where's the better bang for the buck? But from the standpoint of different options and what's out there and how does it work, really the only one out there, if somebody were to advertise, I can offer FHA loans with no mortgage insurance, I mean, that's a flat out lie. Is it mean, or anybody else, can offer that piece at any loan to value? But from the standpoint of offering conventional programs, VA programs, I didn't put it in here, but even USDA will offer 100% financing, and the USDA website flat out, they have no mortgage insurance either. So just from the standpoint of, what would be in anybody's best interest, it doesn't take much for us to price options for people. And I think for the most part, if I don't create options for folks, and they shop elsewhere that does create options for them, it might be that they're gonna opt to work with another individual that at least is a little bit more bright-eyed or wide-eyed and looking at, well, have you thought about this? Have you thought about that? And maybe it makes no sense for them, but at least we've explored that and we've exhausted each and every option to get you the most favorable financing terms for your situation. Ultimately, that's what we're looking to do at the end of the day. And not just, lazy, like, oh no, everybody's just going into the same bucket. It doesn't matter to me. You're going to, pay the man. So it's from the standpoint of what's out there, every piece that I put in here, I'm Greg. My cell phone number's this 595 number. You can call me anytime. Everybody else does. Might as well pile on. Yeah. And I got no problem with it. I encourage it. And my first call this morning was at first text this morning was at 6:50 asking, do you have time to talk? Do you have 2 minutes? And there very rarely is any conversation 2 minutes. I'm not saying it couldn't happen, but I'm helping to work through it. My business email, and we're 21st Century Lending, which is a DBA within the same parent corporation that Century 21 Masters operates under. So we're all on the same team. Proverbially, we're all wearing the same jersey. So, from the standpoint of me to you, stop sharing. Let me see who's in our wonderful chat boxes. Yeah, Laura, good question. Is it similar to 10.1% down or no PMI? So there are programs out there that offer, UWM is great at it. They have programs that they'll offer just below 89.99% or 89.9% loan to value with no MI. So there are some lenders that have unique products and programs where they'll price out. You get to a point where you're less than an 85% loan to value. I mean, it might be, why on earth would you ever take a second? The monthly MI based on their credit score and the low loan to value is like $31 a month. Maybe it doesn't make sense. At a lower credit score, maybe it makes all the sense in the world. It's, if nothing else, it is just talking, and kind of kicking around. We do have ability, Adriana, about doing loans in Nevada as well. So if you have them and you want to shoot any scenarios to me, we have many more real estate agents within the brokerage than loan officers. And literally it's about a 10-to-1 ratio. We have in like mid 500 in real estate agents and brokers working within the brokerage, and in the low 50s with regards to licensed loan officers. But yeah, I can definitely put you fourplex 8015.5. Laura, I'm going to write down your contact number. Last week, unfortunately, you had put together a scenario for me and I didn't know how to get a hold of you. So I will price your scenario, Laura. and I will call you back at your 949 number. 229-0848. So yeah, if nothing else, from the standpoint of mortgage insurance, yes, I will put my contact information.
All right, good stuff. Greg, you're the man, dude.
Thank you. I appreciate you.
Right.
Any other questions? Anything else that you guys got? I just put my contact information up in the chat box. And like I say, no, there's nothing. There's some people are like, oh, I feel like this is a silly question, whatever. I'm happy to knock it out. And those people that do call, I try to catch every call. I mean, if I miss you, I'll call you back as soon as I can. But even if you're not in my contacts, I'm not a big fan of the quote unquote telephone tag and chasing people back. So, all things considered, I'll try to catch back as soon as I possibly can. If you want to leave me detailed messages or anything that I can help you out with, even if we're not working on a transaction, I'm happy to help people out. It makes the world go round. Appreciate you, Robert.
I didn't do anything.
Two thumbs up. And these aren't even emojis. They're the real deal.
Real thumbs. Oh, man.
Excelente.
I tell you, good stuff. I got to encourage everyone on here, each day I try to learn a little bit more and more different things the company provides. And, we had Tess. I don't know, is Tess on here? Well, Tess not on here. Tess from our Diamond Bar office, who's a Centurion year in, year out. She has been working with our lending team, since the merger, and she's just referring leads over left and right, and she can't be more thrilled. So, the people that we have on this team, they're good, they're responsive, they'll work with you. And in today's day and age, with how fragile transactions are. I don't know. I mean, some of you know this, were involved with transactions, but 25% of transactions fall out of escrow, which is the highest, at least in my real estate career, it's ever been. 25% will fall out of escrow. And the main reason they fall out of escrow is typically financing, because appraisals coming in short is like one out of every blue moon. It's almost guaranteed the appraisal is going to come in at the list price, or whatever the agreed upon price is. Inspections, every so often, it could be request for repairs. Almost every deal that falls out of escrow is something to do with finances. And think about the amount of time, effort, and energy you put into getting a client, following up on that client to get them into writing up an offer, or go and show property, write offer, get denied, write offer, get denied, write offer, get denied, write out, get accepted. Yes, go through the appraisal, go through the inspection, and then there's a financial issue. It's like, oh, wasted. So if you enjoy that, just keep doing it. That's fine. But if you don't enjoy that, you got to get with a good lender, good lending company that can make sure they're catching any potential issues up front and explaining the whole detail to the client. And that's what Greg and our team of lenders are doing at 21st Century Lending. So all I can ask is second opinions. Okay. Robert, I've been loyal to my lender. Great. Get a second opinion. That's it. That's all I can ask. Right. But we got a great team here. So
I will say my contact information in there too. That no matter who you're working with here, you always have me also. So I'm happy to help. I'm happy to reach out to people. If you're struggling to get a hold of somebody, I'll jump into it. The way that we're set up here internally is I have admin like authority with our loan processing software and with every lender that we work with. So right, wrong, or indifferent. You could have a loan that's submitted, holy cow, what's going on? I'll take a call anytime. And I worked all New Year's Day. I think I started maybe at 9 o'clock in the morning, and my last call was about 3:30 or so that afternoon. And it had to do with people like, I need to know right now, what's this, what's that. I can go into anybody's, website, lender site, our internal program. Unless there's, somebody's just off the grid, or there's some family emergency, for the most part, I can reach out and get a hold of any one of our loan officers. And from a training standpoint, with everybody on our side, the fact of the matter, and I'll just share two like little parting comments. One of them is that we realize that we're as good as our last loan. And I think anybody that works in a lending capacity or any referral capacity, that that you can't rest on your laurels, and you can't say, well, I've done, right by you for the last dozen or the last 50 or 100, whatever. The reality of things is, we need to constantly, perform and do right by people over time, or it's not there. And then, like I say, if for any reason you can't get a hold of anybody else you're working with on our side, or any questions, we do have weekends as well. No problem, Laura. I can have people also help you with open house flyers. If you want on any of your open houses, we can create beautiful flyers with financing options. We can have people that partner up with you. We have loan officers that work open houses. If you want a tag team, or if you, are just, listing agents are just too busy, you need somebody to help you out, I can get people to step up and work open houses all over the place. It's not even a geographic area. So, we definitely have, power in numbers. So from the standpoint of the offices, and qualified people, I'll make sure that you're set up with somebody for success, and not just throwing a warm body at it.